Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions. Today's episode, we're talking about employing your children.
Yes, sir.
All the ins and outs of that whole, not the relational ins and outs, just
Right.
the accounting ins and outs, I should
Well, let's say the
say.
tax ins and outs.
Right, okay.
And where I started this, you and I were talking before, I made a blog post about this, I don't know, 3-4 years ago. And it was like the most, as viral as my blog post can go, it was the most viral.
Yeah, and
Let's
I
say
wasn't
that.
convinced at first. Like, it didn't make sense to me that this, I guess
Right.
I have, 2 daughters and they're not young enough to work yet.
They're not old enough to work yet.
No, that's right. Yeah,
Watch it.
that's right. Yeah.
Yeah, it's I think it falls under, I think it kind of tickles this itch, what I'm about to say, like in this world, in the tax world, especially people that work with CPAs that make a little money, they're always looking for like that little thing to say. What did we say at a cocktail party? People talk at cocktail parties about this kind of stuff.
Yeah, loopholes.
Of course.
People want loopholes.
Yeah, but they're like my CPA does this, or did you we did
Yeah,
that.
yeah.
Like kind of the clever under the, and I'm not gonna say under the table because we're gonna talk about legitimate ways to do it. Like kind of the I've got the scoop, I've got a guy sort of thing.
Right.
Like, and so this, and I get it all the time. This, Marcus, I'm looking for somebody aggressive, somebody creative. And what a lot of times people mean is, well, I'm not going to say what they mean by that, but
Yeah.
you get my point. But this falls under that scratches that itch, the old,
Yeah.
let's get aggressive, let's get creative, while
Right.
still being reasonable and something you can definitely do legitimately.
Right.
So let's talk about the basics, high level view. And we'll get nuanced into the how it works, what entities to do it in, and all that kind of stuff. But let's just, for discussion purposes, let's just say you, as a small business owner, when all said and done, you pay tax.
Termite company again.
Termite company,
That's
our,
one
our,
we
our
keep
pest
using.
control
Yeah,
business.
pest control business.
Okay, but let's say this pest control business is really killing it, right?
Yeah.
And the owner is
Killing
in the
bugs.
Yeah, that's right. And the owner's in the 35% tax
I'll be
bracket.
here all episode.
He'll be here all week. Tip your waiters, folks. So the owner's in the 35% income tax bracket when all is said and done, when all the income funnels down, because we talked about it, maybe it's a flow-through entity, pays tax at a 35% rate. Okay. And the owner's like, man, I got to find some deductions. I gotta really figure some stuff out. And one of the things we might mention is, well, how old are your kids? And if you're doing the tax return, you saying that question, but you already know the answer. Right? So let's just say you've got kids who can do some work. So step number 1, got to be legitimate work, right? You have to have things for them to do. This isn't like the guy who plays quarterback in college who gets paid $50,000 to sweep the floor at the auto dealership from the big booster. Like, it's got to be legitimate work that you can substantiate. But here's the gist. If you pay them $10,000, you're in a 35% tax bracket. So let's start with the math. That $10,000 deduction saves you $3,500, right? Mm-hmm. Now that $10,000, so you get a deduction and it's ultimately taxable to your kid. Well, let's just say that's the only income they have. You don't have to file a tax return until your income reaches, in 2020, it was $12,400 because that's the amount of the standard deduction, right? So your income would have to exceed the standard deduction before anything would be taxable. So you've created a situation where you've got a $3,500 tax savings to give the money to your kids where you're probably already giving them money for all sorts of things, and it's not taxable to them. So you've created this arbitrage, so to speak, of making something that was previously personal, i.e. things you're paying out of pocket for your kids, and now made it a tax-deductible expense. That's the gist.
Okay.
And so when people say, I'm going to roll back again and say, people say, I need you to get creative, get aggressive, what they mean is find things that I'm already paying for personally and make them deductible. That's what people mean when they say that. My job is to tell them, is really to bring them into the real world and say, well, let's do it right. Let's do it through legitimate means. Let's have a business use, all those things. Let's not remodel your house and call it office expense. I've heard that one before. But this is one of those things where you can legitimately take it from something you were already going to pay for your kids, i.e. that new basketball goal or that summer camp they want to go to, run it through your business in the form of paying them a legitimate wage for doing legitimate work, get a tax benefit, and they pay no tax on it.
Gotcha.
So that's the overarching theme.
Okay.
Make sense?
Yeah, it does. So, like, I mean, is there like an age?
There's not,
like,
but it's a common sense approach.
yeah,
Reasonable pay for reasonable work, right? So I would say unless your kid's brilliant, you're
Yeah.
not paying them at 6 years old to be a computer programmer.
right.
Like,
They're not making, $100,000.
Right.
He's a savant. I swear.
that's what I tell you. You should see him. He plays the piano blindfolded. Like, you just know. Like, I
Right.
think when you
to that end, I guess this always begs the question in my mind because, I've never been audited. We keep everything on the up and up.
Yep.
Like you've always managed that real well, but how does it work? Like, how does that work if you were to do that? I mean, is there are there specific rules, or is it just that vague even with the IRS?
It's just reasonable. It's just it has to be ordinary. You get back into these theoretical tax concepts. Ordinary and necessary are two concepts in the tax world for getting deductions. Meaning, is it ordinary or customary in your industry to pay this kind of wage for this kind of job? Like when you start asking the questions of, can I do this? Like you already know the answer. I tell my clients a lot. So when they start well, what if we did this? And they kind of got the wink, wink, nudge, nudge thing. It's like, well, you're asking me because you already know. You just want me to bless it, essentially. And so I think you could maybe be a little aggressive, right? I think there's some gray area there. Of course, the point you're bringing up, there's no hard and fast rules on this. But at the same time, operate under the hogs get fat and pigs get slaughtered kind of concept. But I say right? Pigs get fat and hogs get slaughtered. Yeah. But you get my point. Like don't go crazy with this stuff.
Yeah.
Don't go paying your 12-year-old $85,000 to wash the company cars. Like,
Right.
just make it reasonable and maybe pay them a little bit more. But just be thinking like this is a tax savvy play. You weren't getting the deduction anyway.
Yeah.
Take it for what it is.
Yeah.
And I think if you just approach it from that standpoint of reasonableness, I'm not trying to get over on somebody, but I got a legitimate not aggressive, but a legitimate creative tax move.
Yeah.
Then take it.
Now, do you recommend? Because I imagine there's a spectrum, right? Like there is everything from hey, I'm imagining my daughters, right? They already love to help out, especially with Val's business.
Congratulations, by the way.
Yeah, yeah. So
Mine don't.
yeah, well, they're like I said, they're young, so
Yeah.
it's still
They're not jaded yet.
exciting. Yeah,
Yeah.
exactly. Like we haven't gotten the eye rolls of whatever. But at this point, it'd be too young. I mean,
Yeah.
but there's a spectrum of okay, I can see them just couple weeks out of the year helping out with shipping
For sure.
versus maybe when they're older, legitimately managing something.
Absolutely.
Where in that spectrum do you recommend even filing it this way? Can it be done retroactively, or is this something they know they've got to be on payroll,
Yeah.
or can you just say no at the end of the year? Oh, well, I'm just gonna say that I paid Johnny $10,000.
You could do that, but here's what I would say: you need to run it through payroll because that's where they being your child gets the most benefit in the sense that if you pay them kind of like where we started the conversation, if you paid them up to $12,400 as a W-2 wage earner, so to your point, through payroll, they would not even have to file a tax return. Okay. But if you paid them like a contractor, which is the whole, let me retroactively just kind of say, maybe $10,000 I took out of the business, I'm going to kind of paper it up and say, no, that really was a payment to my child. Now they've got to file a tax return. And even though they won't owe income tax, they might owe self-employment tax because it was a 1099 contractor kind of situation. So the best place to always do this is through payroll. Mm-hmm. And then what we hadn't talked about is there's certain types of entities where if you run it through payroll, you as the business owner get even more savings because you don't owe the payroll tax.
Yeah. Before we move on to that, though, payroll, you can still do that. I guess I'm just thinking there are going to be some, I'm trying to think, I don't know that, I love the summer camp scenario.
Yeah.
I could see one of my girls being like, no, I want to go to this, camp, and let's say it's $5,000.
Right.
And we just said, okay, well, to do that, you need to be working on the weekends, a couple hours on a Saturday, whatever, for whatever we decide. But that's just kind of our in-home negotiation, you know, but I'm not going to literally set up a bank account and give her $5,000 in
Yeah.
a bank account
Yeah.
for her. You know what I mean? Like,
Yeah, and
how does it like work in real life?
so in real life, I think what you could do is you could paper it up on the back end.
Okay.
So you could say, I paid them $2,500. Let's go in and create a salary that is that plus the payroll. Like, let's back into what a gross salary would be.
Okay.
Let's make it net to zero through either. You can manipulate it in your payroll to where it's a zero paycheck, but the taxes are handled properly and it's reported properly, and then you're done. So yeah,
Yeah.
there's a way to do it that where you kind of just retroactively back into it and paper it up, so to speak.
Okay.
Yeah.
All right.
But still run it through payroll, to your point.
Yeah,
Yeah, because I
exactly.
get it. It's practical. You're not going to be like, well, did you turn in your hours this week,
Yeah.
Susie? Like, we got to get you
yeah,
paid.
And I'm just thinking too, like, I don't know. At some point, you'd hope your kid can manage a bank account.
Correct.
That's
But not
obviously
at-
part of this
But
process.
not, correct.
you
But
know.
not at 8, 9, 10 years old.
Right.
Yeah. No, it's a good point. I think what you do is you set it to where you do the accounting such that you make it a net zero paycheck, so nothing really to do, and then but it still gets reported in payroll and issued a W-2 and all
Yeah.
that kind of stuff.
Gotcha. And that was really my question. Is
Yeah.
like, all of that can be done at the time of filing if you just talk to your account. Like, if I would just say, hey,
Correct.
like, here's how we're going to kind of do this.
Yeah, we would do it. Yeah, we want to know more so before you're planning to file your tax return because it's a payroll thing. So with payroll comes deadlines about when you have to pay in payroll taxes and certain. But so you want to do it timely, but you could aggregate all of it and then say that's going to be in this one period,
Okay.
maybe.
Yeah. All right.
Yeah.
Okay.
Yeah.
All right. So what kind of entities
All right. So the
work and
two.
which ones don't?
Yeah. So what I described at the beginning was income tax, right? I was saying, if you paid somebody $10,000, you're in a 35% bracket, saves you $3,500. We're talking income tax. So that doesn't change amongst the entities. It's still a tax deduction to you, taxable to them. Okay. What changes if you do this in a partnership or a sole proprietorship that are owned exclusively by the parents. So that's the key. Which a sole proprietor would have to be because it's a single person.
Right.
But a partnership would have to be a husband, wife.
Gotcha. What about two partners that have two separate kids?
No,
Like,
won't
just
work.
like, okay.
Yeah, has to be 100% owned by the parents.
Okay.
What happens is you don't pay any payroll tax. So if you're listening to this and everybody here has worked for somebody, I'm sure it's gotten a W-2 where they withhold Social Security and Medicare, and then they being the employer because they have to pay that to the government, and the employer matches it. And it's to the tune of about 15%, around 7.5 employee, 7.5 employer. If you do it in a sole proprietorship or a partnership owned by the parents, those taxes, you're exempt from those taxes, I think, till they reach 18.
Gotcha. So, like, you own a family restaurant and you have your,
Yeah. You pay them through W-2, but you don't have to withhold Social Security or match it. It's really cool.
Yeah.
So it's because as I'm saying this earlier, I mean, the 35% somewhat gets mitigated by the payroll tax, but in this example, it doesn't.
Yeah.
So it's a nice little tool to be like, I'll pay you. I don't pay any payroll tax. Like, I don't incur any additional taxes to pay this to you.
Right.
It's a neat deal.
Yeah. Okay.
Yeah.
I'm trying to think of how I can get more kids.
Right. You wanted to adopt, didn't you?
Yeah, that's right. We'll have to fast track this.
Yeah. So I think there's, and one of the things we hadn't talked about, we're kind of focusing in on the parent side, but one of the, I would say, intended consequences of this is, so if you pay your children, and let's just say you didn't want them to touch the money, which is what most people I think are going to do, then you could then divert that money to a Roth IRA, because the rule for contributing to a Roth IRA is that you have to have earned income. Well, a W-2 wage is earned income. So think about it. Everybody here, I think, has seen these calculations of compound interest.
No,
and
I'm already
everybody's
getting
like,
one.
oh, the eighth wonder of the world is really compound interest, especially when you start early. Think about your kid at 12 years old putting 6, 7, 8, you can't put more. I think $6,000 is the limit in 2021. Putting that in a Roth IRA. So you paid them $6,000 and you're like, look, you're not touching it. I'll put it in your Roth IRA. Imagine doing that, $6,000 from 12 to 18.
That's almost worth it more than the
I know.
summer camp deal
I know.
in my mind. Because I'm thinking you're thinking of like tax deductible savings for your kids.
Yeah.
Like outside of college, there really isn't one,
Right,
right?
right.
So, I mean, that could be a way.
And not even tax. Yeah, that's so you in essence, your point's right. You in essence make your business paying them a tax deductible contribution to their retirement.
Yeah, no,
So it's a neat tool.
That's way better.
I know.
Because I was thinking,
We always do this where I'll say something, you're like, why didn't you lead with that?
yeah. So let me make sure I understand it right. Like, let's say, for example, I mean, and maybe you don't max it out, right, to $6,000.
Yeah,
but
let's do 5.
But you're saying the idea is that as long as it's a wage, if they get a wage,
Yep.
you can start an IRA.
So think about it this way. A wage is what opens the door to being able to contribute to either a Roth or a traditional IRA.
Okay.
What's the kind of the gatekeeper is earned income.
Okay.
Because they were meant for people who work. We want you to be able to contribute to a retirement plan.
Yeah.
So your kid now works.
Now, is there like you mentioned, there's a max on what you can contribute to an IRA,
That's right.
but is there any kind of ratio that like you have, like if you only make $3,000 in a year because you're
Correct.
12,
Right. You can't contribute more than you make. It's
Okay.
limited to your earned income. So
So is that the tip? You can't contribute more than
Correct.
you earn, but
That's right.
you could do the same amount.
That's right. It's limited to the amount of earned income you have.
Oh, I didn't
so
understand.
so having earned income is the first domino.
Okay.
Okay,
So
I've had
let me
earned
just
income.
make sure I'm spinning back to you. I pay my daughter $6,000 over the course of the year.
Right.
$3,000, we say, whatever. That's, I mean, hers. She goes to summer camp, does
Correct.
whatever. The other $3,000,
Roth IRA
Roth IRA.
all day long.
And she's like, based on a spreadsheet I saw, like a millionaire.
And she
by the time
wakes up
she's
at 20 and
24.
she's got
Yeah.
50 grand in a Roth
Yeah,
IRA and she's
exactly.
like, thanks, Dad.
Yeah, and I would say, all right, this is your blood all in a wedding or whatever.
Whatever. I mean,
Take the penalties, I guess.
yeah, I mean, it's a great
That's
tool,
true.
man.
God, that just ruined it for me.
But it's not. But Roth IRA, not to get too much into that, but Roth IRAs are like a glorified savings account because you can always tap the contributions. Because
You just have to pay the taxes on.
no, not on contributions, on the earnings. So let's work that example forward. Let's just say for 5 years she put in 15 grand, $3,000 a year, and 20 years later she's like, man, I could use 15 grand. Roth, what they call ordering rules, say that a distribution from a Roth is deemed to first come from the contributions. So let's just say that account grew to 45,000, and you went to take 15. The tax law says the 15 first comes from the contributions, which come out tax free.
Okay.
Because when you put money in a Roth, you didn't get a deduction. So you shouldn't have to pay tax when you pull it out. It's just the earnings component.
Okay.
And the ordering rules say that the first of that 45,000, the first 15 off the top are contributions before you dip $1 into the earnings.
Yeah.
At which point those become taxable.
Okay.
If you're doing it before you're 59
Now,
and a half.
because they're below the $12,000, do they pay taxes? Do you pay taxes on the IRA contribution?
No.
Okay.
Well, they wouldn't pay tax on their salary, which is what allowed them to make an IRA.
Yeah, exactly.
Yeah, if you kept
Whereas,
their
like we would.
Yeah, if you kept their salary enough that it was below the standard deduction, what I led with
Yeah.
that. So if you paid them 10 grand, the standard deduction is 12.4. They don't even have to file a tax return, which also is a little note here: don't withhold any federal and state income tax, because then you'd have to file a return to get it back. So don't do that.
Okay.
Pay your kids. Don't withhold any federal and state income tax. Override the payroll in Gusto, or whatever you use for your
Yeah.
payroll. Don't withhold anything, because then to get the money back, you got to file a tax return, which is the whole point of paying them less than the standard deduction.
Yeah.
And then you could not have to file a tax return, put it in a Roth IRA. It's lots of stuff.
Can they have their own HSA?
Ooh, no, because they don't have, they don't have high deductible
I'm
health
just
insurance.
imagining like my daughter being
It's like-
12, paying her own medical bills, and like
They're like, she's
like-
loaded.
Yeah.
Did you
like,
hear what
she's
so and so
got a-
has? She's got an HSA and an
yeah,
IRA.
exactly. Like
Yeah. No, it's
That'd
good.
be
I mean, it's
amazing.
almost making me want to talk about an episode. Have we done one on? I think we did one on like educational planning, but it was
Yeah.
mixed in with retirement. I
yeah,
wonder if we.
we kind of just hit bullet points. Of
I wonder if we ought to go deeper, because now all the questions are coming out. Like, go deeper on this kind of retirement stuff.
Sure. But no, I think we unlocked some. Basically, I think you said it well. Like people are always kind of looking for some kind of unique angle,
Right.
And this one
Get
sounds,
creative.
Yeah,
That's the term.
exactly. Right.
And we have to just, we have to say, well, look, man, we do everything we can. We'll use the tax law to your full benefit, but
Yeah.
there's just you can't remodel your home and call it office expense.
Right.
Yeah.
Yeah, but you can put your kids to work and
That's right.
get the benefits.
Yeah, it's really
And
it's really
you decide whether the benefits outweigh the cost of whatever
Right.
that looks like for your kids to work for your company.
Right. And I will say this. I mean, I always kind of bring it back to this point, but it is true. You're not getting that with your year-end tax return. Like, if you pay somebody $300 to do your tax return, like, don't expect, what is it, champagne on a beer budget? Like I get that all the time. Like, my CPA doesn't give me ideas. He doesn't call me. It was like,
Yeah.
well, you're not paying for the ideas. You're not paying. You have to get in a situation where people know that ideas are part of the conversation. So if you want these tax planning tips and you want the kind of relationship where somebody's looking out for you, you got to work with them throughout the year, which means hopefully from the CPA perspective, you're paying a little bit more, but they're saving you more. The goal of us of our profession is to pay for ourselves. So hopefully we're doing enough to where it pays for itself. But you're not going to get that with your $400 after the fact tax return. That's just how it is.
All right.
Preach.
Yeah. I thought you were about to start naming names. All right. Well, we'll end it there.
Yeah.
Ultimately, if you've got kids and can put them to work, it's worth, it's worth
It's worth a
doing.
conversation. Ask your CPA
Yeah.
about it. They'll know about it. Really
Yeah.
common, somewhat overlooked just because it's sometimes not huge, but just for what you said, just to put the money in the Roth IRA might be worth
Yeah.
it.
I mean, if you're trying to do that anyway, right? It's just
Yeah.
another, because, that's what excited me was just
Yeah.
like, there's not many tools for that kind of,
But you're about to start.
oh, yeah.
You're about to start taking advantage of them.
I know. Oh my gosh. All right. I'm just imagining, again, scenarios of them having, how to teach them how to use money first.
That's right.
Yeah.
I'm thinking of this. I'm thinking of what's her name from Clueless, like driving up in the Corvette.
Yeah, exactly. Right.
I can't remember that. Anyway.
All righty. Well, we'll end it there with Clueless reference, a failed Clueless reference.
Right.
So, all right. Well, you can always check out more episodes at Mire.group and certainly reach out to Mire Group there and Marcus directly. So, we'll see you next time.
Yep.